Moving ahead, for our first panel discussion is on the topic Changing Phase of Banking. And for this session, we'd like to invite our moderator, Mr. Yashraj Erande, India Leader Financial Services and Global Leader Fintech, Boston Consulting Group, and our panelist, Mr. Rajiv Anand, President, Bombay Chamber and MD and CEO, IndusInd Bank, Mr. Anirban, Mukherjee, CEO, PayU, and Mr. Sachin, Seth, Regional Managing Director, India and South Asia, CRIF, to kindly join us on the days. Round of applause for our speakers, please.
Rajiv, you said a couple of things in your speech which I think are going to resonate for a long time. The first one you said is that this is a business of trust. And the other thing that you said is that this is a profession of constant adaptation. You started adapting in September of 1990. So 35 years of financial services, not just banking, but more broadly. Can I kick this discussion off by requesting you to reflect on, before we talk about the future, about changing the face of banking, how has banking and financial services changed in the last 35 years?
I think that as we think about the last 6 months, 1 year, 2 years, we tend to forget how much we have achieved as a nation, as financial institutions in this country. I started my career in 1990. I still remember the time when we used to get large value RBI checks on interbank. I used to be a money market dealer in those days, and we used to get checks, and the checks had to be banked because otherwise CRR compliance then become an issue. I've had instances where I had to, my office in HSBC was in Fort. I had to run to RBI to deposit the check because, you talk to young people today, the whole concept of a check itself is obsolete, and now you can actually transfer very large amounts of money electronically in a matter of seconds. Second is, I think, the evolution of the capital markets, and I think it's been a phenomenal story in the early 2000s. We had a handful of mutual funds. Forget about whether people were coming in. The whole concept of a mutual fund itself was alien. I mean, Morgan Stanley launched a mutual fund in those days, and it was an open-ended mutual fund, meaning that after that you could buy it at any point in time. But in those days, people thought it was like an IPO, and there were lines around Hong Kong Bank and Grindlays Bank in those days in Fort, because they wanted to put in that subscription into the Morgan Stanley mutual fund. Physical settlements. I remember in my mutual fund days, Deutsche Bank, everything was physical settlement. Deutsche Bank used to have this massive vault in Parel, and then virtually overnight, physical settlement in India disappeared, and we all went to DMAT, and that vault, I don't know what it's become. It's probably become a aquarium or something. I don't know what they've done with it. But I think the rapid changes that we have seen, as you look back 30 years, I think it's been a phenomenal journey. And as a child of liberalization, having been part of that journey over the last 35 years, in the capital markets, in banking, I think it's been a phenomenal experience. And so therefore, there's a lot of stuff that we take for granted, but today, we today stand on the shoulders of people who have had the vision to bring us here, regulators, market intermediaries, banks, other financial services entities, etc.
Rajiv, this is fascinating. I have heard you speak about this second time, and a few things that really jumped out at me, and I think this is good way to think about the future. The first thing that jumped out at me was the metrics of measuring financial services has gone from days to seconds. So the unit has changed.
In the previous generation will probably remember that people used to take 1 day's leave to do what was called bank work. update your passbook, get a new checkbook, etc. I mean, can you imagine having that conversation with a young person today? Or to look at it differently, that's one day of productivity that we have effectively saved for people.
Yeah. So days to seconds. The second thing that jumped out at me is atoms to electrons. We used to have paper, there is physical atoms, and now it's all dematerialized electrons. And the third thing that jumped out at me was real democratization of access. I mean, having an SIP of a few hundred rupees is totally different. So we have come a long way from perhaps the time when high frequency trading meant who could shout the fastest on the, on the exchange floor to now where things move in a matter of nanoseconds. But I want to move to now Anirban. I want to pull you in and ask you the other side of the question, which is, imagine you are sitting in 2040 and you're looking back at what has happened to financial services and banking. What would it look like in 2040 according to you? What would be same? What would be unrecognizable?
Yes, great question. I don't think that far, but even in 10 years, a lot more will change. In 15 years, I think banking, payments, all financial services will be totally contextual, totally embedded, and totally, in some ways, invisible. But there, right? We used to say bank is a place you go to. So banking is something you do today, and eventually it will move to what Rajiv said, which is it's just embedded in the needs and the flows of what happens today. Like, I'll give you a simple example of what is happening, starting to happen today. Think of a restaurant on a food delivery marketplace or a seller on a large e-commerce marketplace. They can borrow on Friday for 1 week. They can borrow for 3 days if they want, all pre-approved. And the front end is an LSP or a Fintech like us. The back end is a bank. And those things are happening today. More and more of that will happen. Right? So that is one thing that will happen. The second, though, the larger thing that will also happen is, I think there is much more financial services, like much more penetration of financial services that has to happen. And that comes from being able to do really low ticket sizes and much more contextual, right? Whether it is lending, whether it is wealth, whether it is insurance. I think Gen AI will change a lot of that. Both costs will go out of the system, but our ability to understand customers at scale will just dramatically change. And that will therefore make, I think the true power of Gen AI is in education, health, and financial services, and taking it deep, deep, deep into not only in India, but into the 7 billion people of the world, 4 billion of whom are not well served today. I think a lot of that will happen. You can see the transformative power of the technology on both sides, both helping figure out what does this person actually need, because we're not very good at underwriting them or reading them, as Rajiv said. And also, the cost to serve has to go down dramatically, right? In everything in India, the revolution happens when costs keep coming down, the marginal costs. I think there's a lot more to happen there. I would say those are the two big things. Totally embedded, totally contextual, but also far more deeper and far more customized for the last mile.
Oh, fascinating. The contextual and embedded part makes a lot of sense. And what you said about driving financial access to the last mile, it's so hard hitting, Anirban, in some sense. In the Global Fintech Fest, which happens now every year, there was a very interesting chart. This was about, if you have a fintech app, what's the extent of financial penetration of that app in different parts of the world? It's exactly the same app, but it has completely different outcomes in a rural town of India versus a place in Europe or US. It's the same technology. And if you ask why that is the case, amongst many other things, it talks to, I think, what you brought out, that it's not just about having app and technology, it's about financial literacy. It's about digital financial literacy. And I think we are also heading towards AI financial literacy. So having a world which traverses all of these arcs will be quite fascinating. But this brings me, Sachin, to you. You represent a CRIF, but you represent a business which is in the business of insights, open banking, data insights. And in order to have embedded finance, it's not possible to do that without insights and without open banking. So what are you seeing happen in the industry today? We have spoken about the past, we have spoken about the future, but as you sit here today and as you look at this, what are you seeing happen in the industry today which is giving you signs and hints about important shifts which are happening, which will define the future of face of banking?
Thank you, Yash. So obviously there's many things happening, and I don't think I'll have enough time to address all of them, but I'll just pick up some of the bullet points.
We have 36 minutes.
Yeah. But if you look at it, I mean, as we all know, there's nothing new I'm saying that, the transformation of banking is happening across the board. Last 10 years, we have seen payments, we have seen wealth management, we have seen transaction banking, we have seen all parts of banking getting realigned. And obviously there are macroeconomic factors playing out. Most of the CEOs are talking about today the deposits issue, what they are facing, etc., etc. But coming to the specifics of what is happening in the banking and what data we see, specifically from lending point of view, because that remains a very, very big portion of the banking's income portfolio, let's say. Today, every bank is trying to become a universal bank. Now, that obviously puts a lot of pressure on the cost to income ratio, OPEX, distribution costs, etc., etc. That's the aspirational part of it. But at the same time, we also see that a lot of leading banks having challenges of cannibalization of the resources, or let's say sources of income. So one side, they are trying to push products, push deposits through their own channels, but at the same time, they are also trying to build a partnership channel. So at this moment, I would say the leveling of water has not happened. And because later on they discover through various kind of data sources that this customer I could have acquired myself at a better price point, which I am acquiring through partner, or I am probably leaving some money on the table. So there's a little bit of I would say, arbitrage which is there. I think this is definitely putting a lot of pressure on the overall banking ecosystem because typically there's a risk averseness which probably people would not like to lend out to the people whom they don't know well. At the same time, if you see the distribution between banks itself, public sector bank, private sector bank, NBFC and Fintech, these are the four pillars, right? Public sector banks have tried to take advantage of that situation by significant digitization over the last 10 years. They were lagging behind. In our reports also, and we have published that in last 6 to 9 months, public sector banks have taken a significant leap. Their portfolios are improving on personal loan, home loans, etc. Fintechs obviously continue to grow. So while the personal loans didn't grow, but Fintechs, the survey we conducted with Fintech, Digital Lender Association of India, we found that all the digital Fintech actually increased the portfolio by 35%, right? So which means that private sector banks continue to maintain a little bit of a break on that, which was correct. So in this whole jigsaw puzzle, if you see that NBFCs have taken advantage, they have become a proxy to the banking in many segments, and Rajiv did talk about MSME, which is one of the sweet spot MSME is taking. PSU is taking a very strong position. Fintechs are taking a position. And that's where the private sector banking, probably the big ones and the small ones, needs to figure it out from data and insights perspective that what exactly they want their core competence to be. Maybe some of them, and if I take the question which you asked to Anirban, that what will happen 10 years later, probably I feel that people will need to figure out their core strengths. If it's a regional, it's regional. If it's national, it's national. Today, even regional banks are also trying to become national, which plays out in a different way. They may not be able to sustain. So I'll just rest my point here. Data insights is saying that there's a lot of flux happening and movement of customer. Just last point I want to make is that Gen Z, every year we have 3 crore people entering the lending ecosystem. They are NTC. We have almost like population of 35 crore people who are actually having at least one trade line, and we are alive. 3 crore people, last year it was 2.9 crore. 2.9 crore people entered the lending. Now they could have taken a buy now pay later, they could have taken any of the small products. Now this is, right now, unless they have a salary account, they are not going to the banks. They are going through the ecosystem, which are intermediaries. You can call it SPs, you can call it fintechs, etc. So, or even payment companies, right? So I think when we talk about the future of the banking and this Gen Z, which is coming almost like 3 crore, which is almost 10 to 11% of the total credit-worthy market or credit borrowers market, I think this is going to change the landscape very, very significantly in 5 years' time. And that is what I just wanted to put my point on.
It's a fascinating point. The Gen Zs will become, I mean, the consumer will be different. It's already large and different, so the models have to adapt. But you said something about partnerships, and partnerships is an important way to drive efficiency, but it's also an important way to access customer and generate insight. Anirban, in your neck of the woods, you do end up partnering with other players in the ecosystem for data, for lending and other services. How are you, as PayU, what are you seeing gain prominence in the market, which is important and interesting as we think about the changing face of banking? Is it co-lending? Is it partnerships? Is it data-driven, short-term loans, particularly also maybe in the MSME space?
See, on MSME, there's I think the one of the most important pillars by which our whole sector progresses is fintech bank partnerships. You have complementary strengths, right? The access to capital, the deep risk management, the institutional strength that the banking system brings, coupled with the reach and the tech of fintechs, right? That's how I see it. Coming to MSMEs, yes, look, starting the relationship with the MSME, the example I was giving, doing embedded lending inside ecosystems or doing cash flow based lending, the fintech puts all the payment companies, we all put QRs. Some of those QRs are our own. Sometimes they're QRs on behalf of, they're the bank's MSMEs where we put out the QRs. And then you do flow based lending on the back of it. And the bank actually, it's usually the bank's balance sheet. The fintech can do a little bit of exposure. But a lot of it is the banks, because most fintechs have small NBFCs and small capacities. That's where the bank fintech, where the fintech reaches out, builds the solution, helps do part of the data-driven underwriting, and then partners with the bank. But that's one part, right? Ultimately, look, this is also about the experience. Eventually, banking will become more and more embedded, at least the front end of banking, into these interfaces. You can't teach a merchant, like a small MSME deep in the country, you can't teach them to have that many interfaces, right? So you build them the banking interface within whatever ERP system they use to manage their shop. And that's, those are all partnerships that have to get stitched together.
Yeah, value-added services, embedded ERP, etc. We have seen across industries, as those industries mature, they end up developing a stack architecture. And I think some of the points you are alluding to, which is specialization. There's a layer that really deals with facing the customer. One of my friends calls it storefronts. You can call it whatever, wherever the customer spends time transacting. I think then there's a layer that is the efficiency layer, which does the journeys, transactions, that really well. And then there's a system of record or the trust layer where people put their money, capital, data, and you can really trust them. So some degree of specialization happens. This happens across multiple industries. But if we are headed in that direction, then maybe Rajiv, how should banks think about their strategy or the moves that they should make or the priorities that they should focus on, given the way the industry is likely to evolve? More AI, Gen Z consumer, more embedded, greater demand on partnerships, and like literally swimming in data, which can, if you consume it in the right way, can generate very interesting insights. And one bank can look very different from the other bank. You don't have to be a clone of the other bank as you go forward. First of all, I don't know if you agree, but what should be the priorities?
So, I think first and foremost, as we think about what happened to understand the future, I think one of the things that clearly has happened over the last 10 years or so is the liability side of the balance sheet has fundamentally changed. Where bank deposits constituted a significant component of household savings. That composition is changing away from bank deposits to mutual funds, insurance, etc. And that clearly has ramifications in terms of how the liability stack is going to get built over a period of time probably means that the cost of funds is not going to come down, significantly, because the ratio of CASA to total, I think, is going to continue to shrink as we go forward. What is that? Where does it settle? That is a debate that we can have. But fundamentally, that is the piece that is going to be, certainly a challenge. If you look at the other pieces on the ROA tree, which means that, managing NIMs to that extent is not going to come through lower cost of funds, but rather you have to take higher and higher levels of risk on the asset side for you to be able to deliver NIMs, and that in turn brings, issues. The second is fee incomes. Fee incomes, I think, is broadly speaking about 1.5% of assets. I think that is reasonably healthy. I don't think there's too much of play there. And I think it's fair to say credit costs are benign today, but it is cyclical. Through the cycle, it'll go up and down. So then the balancing figure is cost. I think today banks run at a cost to assets of anything between, let's say, 2.25 to 3%. Mutual funds run a liquid fund at 10 basis points. And I think, Mr. Kotak made this point as well, that I think the cost structures that banks work on is in this sort of world is ridiculous. And I think those numbers, I think banks have to work much, much harder to be able to bring that down, significantly, to be able to compete, from a profitability perspective as we go forward. And therefore, to that extent, all this stuff that you spoke about of how can you deliver more and more through technology, how can you deliver more and more through data, how can you deliver on an end-to-end basis untouched by human hand, and eliminate costs that the customer does not consider of value. I think banks will have to become much more ruthless in terms of the way that they're being run at this moment. I think if you look at any competing product, the cost structures are significantly lower than where they are today. And I think, if you look at the ROA tree, pressure on NIMs, not much play left on fees. On the credit costs, there is an element of cyclicality. Sometimes it'll be good, sometimes not so good. Then the balancing figure is cost, which is in your control. I think those need to come down quite, like an order of magnitude more for banks to be able to compete against, other products.
Rajiv, can I ask you a follow-up on that? Because this also perhaps requires a different talent architecture, a different set of people who are solving for these things, a different capability set inside the bank. How do financial institutions prepare themselves for just a very different talent pool?
So, like I mentioned in my keynote, please don't underestimate bankers. I think, when ATMs came about 50 years ago, everybody said, "Arey boss, we don't need tellers." Actually, what happened was banks opened more branches and we actually needed more tellers. And so therefore, I think it's fair to say that banks have been able to keep up with changing technology and changing customer expectations over the last, 40, 50 years. I see no reason why that should be any different over the next, 40, 50 years as well. And so therefore we will come up with, technologies, changes. There'll be some stuff that banks will do. There will be some stuff that the regulator will push us. We will push the regulator to, in terms of moving in the right direction. There are enough business models, and, BCG itself has shown us so many. Revolut is a good example of, how to build a bank of the future. Maybe that is the future that we should be looking forward to.
Makes sense. Anirban, I wanted to get a bit deeper on this notion of partnerships, because some of the efficiency and growth will also come from how partnerships play out. What are the big bottlenecks to partnerships today, and what do you think is really working? Because for all the things we talk about in terms of partnerships and fintech partnerships and so on, I think there is more holes than cheese. There are more holes than cheese. There's a lot more to be done. I don't think we are anywhere near the amount of deeper integrations that we need.
No, actually, look, it works very well on the payment side of it, right? Between banks and fintechs, banks do some of the front end work, but increasingly, like the acquiring is with the bank and then the front end is with the payments company. But to your point, look, here are the things that I think how the relationship needs to evolve is, there needs to be more clarity on how do you share data, right?
How to share data?
In a sandbox environment as well, how do you bring data together to do things together? How do you, like, who owns which part of the relationship? Sometimes that becomes a problem, right? As to how do you, like, just having more clarity around things like that between partners. This is not as much about the regulator. This is about between partners. How do you do that? And to me, if we get some of that clarity about how do you co-create and within the guardrails of all the laws of the land, and how do you decide which part of the customer relationship who owns, when things go wrong, how do you solve problems together? It's almost like, to me, I keep telling my team, each deep bank partnership is like a JV in and of itself. You have to think of this as a common business with common objectives, teams meet together, teams work together. Those things really work when they come together and act as one.
Joint teams.
Yes.
Joint teams.
It works well. When you are kind of, it's fairly arm's length, you need to be arm's length where you need to be arm's length, then it doesn't work that well. That's one part. The other thing is, look, you have to be also clear about relative strengths. Fintechs are good at highly scalable, very low cost, simple products. And then as the customer relationship evolves, that's where banks need to, banks can do the larger ticket lending, banks can do more of the banking products, of course. And that relationship also being very clear about the relative strengths of each other is important.
Makes sense. Getting people to work together, I think it needs to work both on the upside and the downside, because we are seeing that the threat landscape also, or the risk landscape also, envelope is expanding as you do more partnerships. There are more points at which you kind of let risk into the system. And so if there is a deeper coordination, then there is a faster understanding of the risk when it manifests, and there's a more integrated resolution as well. So I think it cuts on both sides. It's harder to do though. So I don't know if you agree, but
yeah, look, I think the mindset has to be that this is a long-term relationship. It's not a short-term. It's not a short-term marriage of convenience, so to speak. It's something that you're committed to till you decide otherwise, right? So most agreements should be long-term, and you should structure it that way. And then I think there are many successful examples across the whole industry in different sectors. It works well.
Makes sense. Sachin, when we were exchanging notes for this discussion, I thought you had said something quite interesting in terms of how the face of banking might evolve for the industry itself. I mean, if you think about the kind of players that will exist, the kind of players that need to exist for banking to serve the needs of a growing economy such as India. What's your perspective on that? Can you play that back a little bit? More specialization, more deeper players, some very large players. What kind of market structure are we looking at?
Well, first of all, one confession, I've never been a banker. So definitely it's a perspective.
You probably have a better insight.
Yeah. So, but yeah, I've been a consultant and then running Insights company. But if I look at it from outside in view, I think, and we talk about a bit longer term, 10 to 15 years. 2 years, 5 years, so obviously we know that where we are heading, right? More or less things are evolving. I think banking will, look more similar to a telecom kind of model, which will be basically a service provider model. Now, naturally, none of us would like to have only that 3 or 4 or 5. I mean, we need to have enough number of players. And we also have in telecom globally a model called MVNO, mobile virtual network operator, etc., which is basically that you have a manufacturer of the product and we have a distributor of the product or branding of the product, right? I think how it could evolve if I see 15 years from now, probably one is that interoperability of the bank account could be something which, like we had in mobile, today I would have changed my same number, my mobile operator maybe 2 or 3 times in 20 years for obvious reasons that, wherever I am located, if the service is better, I would go for that, right? Second is that there would be full service banks. So if you look at the total pyramid, the top of the pyramid generally tend to have the full service offerings because they stop thinking about pennies and they would like to have more convenience, they would like to have a service, they would like to have basically the variety of products, and they would not be able to comprehend the knowledge which is required to manage their money. I'm talking about ultra HNI segment, right? And that's where, while there is enough competition coming from individual, global, or as well as Indian-born wealth players, but I see banks and private banks will have a significant play because people have money and people would like somebody to provide a full service. And that's where everything comes into picture. Some of them may be profitable, some of them may not be profitable in terms of specific products, but as a bouquet, yes. If you see the bottom of the pyramid also, I'm not talking about the NTC layer which enters but just above that, that layer basically also requires a reasonably good amount of service because they also are typically gig workers, migrant laborers, or the people who cannot have 5 relationships. Even if somebody, a fintech, giving them a better proposition, they don't have the wherewithal to understand. If somebody is giving a better payment proposition, somebody giving a better fee payment, etc., etc. So they don't have neither the knowledge nor the wherewithal to really manage this. So they would like to continue relationship with a small finance bank or a local regional bank, which fulfills their need in a similar manner, but with their kind of wealth, which is not so big, but important to them, very important to them, right? I think the middle segment is where there will be a lot more transformation may happen because middle segment is where the intermediaries are playing a lot more part and which is where the partnerships are coming into picture and where we have a mass which is aspirational to build wealth but wants to be picky in everything what they make a decision. So they want to go for insurance themselves, they want to go mutual fund themselves, or direct mutual fund, they want to go bank only with the bank with a particular credit card, all of that, right? So this is how the evolution will happen, but eventually if you see 15 years later, what I see is that the whole banking as a service layer will become an infrastructure layer and there would be services provided as a core services. There would be fintech players, others who will build on top of it. And I think beyond a point it will become an invisible layer, which is what Rajiv did talk about in his initial talk also, that it won't be too much of botheration whether you have X bank or Y bank or A bank. I think all of them will follow a certain standards. And I think consumers will look at the core services being provided by them and the value added coming either from them depending on their category or coming from somebody else which is tapping onto them. Yeah, that's what I think so.
Fantastic. Anirban, I want to ask you a little bit about AI. And Rajiv, after that I'm going to try and pick your brain on this notion of scale. And as we get into the last 10 minutes, we would love to get questions from the audience so that we can have an interaction. So if you want to start jotting down some questions on your mind, please do that. And I hope there's a mic in circulation. Okay, perfect. So Anirban, on again, as we were exchanging notes, you said AI is going to be critical. You said that in your opening remarks as well. But if I'm a customer of a bank 10, 15, 20 years out, where will AI be present? What will the AI do for me?
Look, I think AI,
sorry, can I also, what are you doing about it today in PayU? Are you doing anything?
Yes, we can talk about hope. So 2 different questions, I'll try and be brief. See, AI will change all parts of how we think about a consumer's or a MSME's interaction with a bank, right? Right up front, the first layer itself, like for people in this room, I think we will have conversational banking much more. People, younger than us, people who are born more digital, right? For them, it would be a digital financial assistant. Like, I've already seen enough to say that in another year or two, these personal financial assistants for money, not the chatbots we have today, but real digital financial assistants will be better than the average RM, or at least better than the marginal RM. and true financial advice, right? There is nobody who's quite cracked Google of money, right? If you think about that, that will get created. A true financial advisor, and younger people will start there. We might take time to migrate to that. But even for more established customers, a lot of banking will become, the interface will become conversational. That is fairly clear. Then the product set will change, right? People don't think in terms of savings and this. They say, okay, while I am paying, I see that today. We build recommendation engines. It's, PayU powers a lot of online payments in the country. The recommendation engine, how you structure it, right? People can part pay using multiple things. You understand that they're trying to manage their money in a smart manner. And so the product layer will change. And product layer will change differently for different kinds of people, right? One of the biggest things, for example, on cash flow based lending is, you'll be amazed as you go deeper in the country how seasonal the cash flows tend to be. And if you do cash flow based lending and not classic old like traditional underwriting, you get to the heart of what the problem is, right? That will change. And then the back end will change totally, right? Anything you need, much more things will become zero touch. The workflows fundamentally will change though. But for this, look, the transformation is not about technology itself, right? The transformation is much more about the workflow. How decisions get made and how teams organize. That's going to change. At PayU, we are playing with all layers of this. Look, the back end, like already what a fraud risk is a big challenge in payments, right? What a reasonably experienced fraud risk analyst could do, the LLM can already do some of that already, right? Meaning figuring out this is what the exact category of the merchant is and whether his website shows any risky behavior, etc. Do they have all the policies? And if anything changes, then flagging that. Stuff like that is already LLMs can do. So the backend is starting to happen. Some of the interfaces we are still playing with, some of the products we are trying to build. But starting from, I think my learning is, unless the fundamental workflow and how you organize the work changes, we won't leverage the full power of Gen AI. So it's also fundamental organizational change. That's the whole, AI thing.
That's amazing, amazing, profound. Rajiv, scale, I think, is going to be, in whichever view of the way of think about the future, it's going to be crucial. And I find this a bit of a conundrum. India's GDP is larger than Japan, Europe, France today. But our largest banks are not even 1/3 the largest banks of these countries. So we have a GDP which is as big or certainly larger, it's growing faster, and the largest banks are not even 1/3. And the second and third largest banks are actually much smaller in size. So what I wanted to ask you was that first of all, how crucial is scale for banks as we go forward to support the economy? And as a banker, as you build balance sheets and institutions which last multiple decades, how do you pursue scale? How do you thoughtfully go about building scale? And what will that mean?
So on question one, I think if you keep dividing our balance sheets by 9150, then obviously scale relative to global size will become a problem in dollar terms. I mean, just, but on a more serious note, banking is a scale business. I think, if you look at it across the world, a disproportionate amount of the profit pools go to the biggest banks. And, look at JP Morgan, for example, in the US. I mean, look at the amount of money that they make. And therefore, to that extent, they are able to invest more in technology. They're able to invest more in their people. They're able to invest more in, compliance and regulations, etc., etc. And in terms of the brand. And the big will only continue to get bigger as we go forward. And what that also means is, I think, as far as I'm concerned, the gold standard of, as far as banking is concerned, is when you start to get deposits in a counter-cyclical manner, meaning that when SVB happened, right, there was a flight to quality in terms of to JP Morgan. And JP Morgan was pretty much getting money for free, saying, please take my money. And that to me is the gold standard, as far as banking is concerned, where you are able to attract money at your cost at almost all points in time. And so therefore, I think even in the Indian context, you're clearly seeing that the big banks are clearly growing faster than the mid-sized banks or even the smaller banks. I think this is something that will continue. To the point that you are making, I think it's a valid point that in the Indian context we don't have very big banks, but I think you will continue to see some levels of consolidation at various levels of banking.
Right.
In public sector banks merging with public sector banks, large mergers in private sector banks, both large and small and medium, and certainly at the small level, because ultimately go back to the point that I was making, that banking is a balance sheet business. The big will continue to get bigger, and the scale benefits that they are getting will make it more and more difficult for others to participate in a competitive manner.
No, amazing. I think the message about consolidation and thoughtful is an important one coming from this panel on for the chamber. We are in the last 5 minutes. Love to hear questions.
Now, we explained a lot of innovative models with technology and everything.
Could I also request just a quick introduction before?
Abhiza Devanji, Neostrat. Just a question. We spoke about a lot of innovation that can happen in banking. This applies to PayU, Sachin, everybody actually. But now that I'm sitting on this table, there is a little bit of a connection. But how does regulation pan out to technology? Will we need significant regulatory change to enable the kind of technology we want to implement in banking? What are you just talking about?
I think it's, if you look at, RBI over the last 10 years has been very supportive of, from a regulatory perspective. I don't think you can fault them in terms of, what they have been able to enable and achieve at scale from an Indian perspective. So I think regulations have been very supportive. To say that we are not innovative because of the regulator, I think is an incorrect statement to make.
Yeah, here. Can I?
Oh yeah, please.
So it's only an extension of this. Now with embedded technology, bankers are reaching probably into the company's ERP and SAP maybe. All the real-time data is available. So for transacting, or what will be the role of credit rating agencies in future? Will that be required? That is redundant. With bankers having access and intelligence pool, so they can be...
Credit rating agencies are redundant.
Because I'm holding some stocks of 2 companies.
Can I, Sachin?
First of all, I don't represent credit rating agency. I am just on the board of Credit Bureau, which is obviously for the consumer and commercial lending. But your question is if about credit rating agencies. I think, everybody has their own business model evolved, and there is a lot of data coming from different sources. So whatever data any institution has direct access to, they definitely like to have outside in view at the aggregate level to make decisions. So I'm sure the models what credit rating agencies are following, it has that value-added services being provided. So I believe they will find their own, they will discover their own way if there are, challenges to their business. That's all I can say. I don't represent them.
Just to add to that, I think data is available with everyone. Banks who are able to convert data into insights ultimately will win. But the point is, the way I will look at data and the way you will look at data will be very different. You may think that this is a AAA company, I may think it's a BBB company. Right? And so therefore, bringing a standardization through this process, rating agencies will continue to play a critical role. Because especially as you think about other stakeholders in the ecosystem, investors, regulators, etc. How will they be able to assess unless you have an element of standardization, and that to some degree the rating agencies will bring. Now, rating agencies themselves will have more data, and so therefore their ability to rate, I'm assuming, will also get better.
Also, there's just benefit for the companies who are getting rated. For the lenders, of course, there's their own data and all that, but the companies who are getting rated, they would also learn, and they continue to learn on how do they get better. So,
yeah, my name is Manish Sampath, and I've got two questions. One is that we just heard about how technology is going to take over banking. So what is going to be the role of branch banking? Because we saw even today on a street there are 4 or 5 different branches of branches of different banks. So what is going to be the role of branch banking? And second question is, moving forward, we see we are associated with some banks in some small way or the other. We see that the full focus has now moved to retail banking because corporate balance sheets are strong, they don't require more funding, so therefore, and plus capital market access has become more freely available. So is the focus going to be of all banks on retail, and if so, is there enough space for everyone? I think so. These are the two questions. Thanks.
On question one, I think if you look at it in the Indian context, banks continue to open branches. I think there is a direct correlation between market share of branches and market share of deposits. A and B is typically branches will break even in anything between, let us say, 18 to 24 months. I think that also is currently being met in most banks. So as long as these two continue to play out, I think in the Indian context, we will continue to open more branches. To the question that you're asking, it is not as if corporate banking is not profitable. Just pure lending may not necessarily be profitable, but you have to go out there and capture other businesses from the corporate. Salary accounts, transaction banking, FX, investment banking services, etc. You have to lend to be able to sit at the table. So therefore you have to lend some amount, otherwise all these other businesses will not come to you. So some business will come to you because you're sitting at the table, some business will come to you because of the fact that you have better skills and capabilities than other banks on the street. But I think to the question you're also asking is what is the composition of the balance sheet? I think most banks will run a balanced balance sheet, let us say 60-40 between retail and corporate, including depending upon which side the MSME portfolio sits. Because I don't think we can make a big bet one way or the other.
Super.
I'm practicing chartered accountant and insolvency professional Devang Sampath. My question is more horizontal movement from people in industry into regulators, or experts from the industry into regulators more ideal in current situation of India?
Talent moving from outside regulatory environment to inside. So industry veterans moving into regulation and vice versa.
Let me answer that slightly differently. I think particularly in RBI, for example, like Mr. Yashraj, they're all career regulators. In SEBI at the very highest levels, not the very highest, at the whole time director level, there has been some participation from the private sector, etc. But I think most important is whether you have people in regulation or not. I think the key is really whether the regulators are on a proactive basis engaging with various stakeholders in the ecosystem, and I have no problem in terms of engaging with any of the regulators within the ecosystem. Do they listen to you? Of course they listen to you. Of course, finally they will make their own decisions.
I think we are out of time, and this is perhaps there are a few more questions we couldn't take, but thank you very much. Thank you very much, Rajiv, Anirban, Sachin. Thank you very much.
Thank you so much, speakers, for that insightful discussion. Now I request Mr. Khosla to please present the mementos to our speaker as our
Thank you. Thanks a lot.
One group photo, please.